Hello, investors. In this video, we'll be exploring a fundamental principle in the world of investing, understanding how different economic cycles influence various asset classes. It's a dynamic relationship that savvy investors leverage to make informed decisions and optimize their portfolios. Economic cycles, also known as business cycles or economic fluctuations, are recurring patterns of expansion and contraction in economic activity. These cycles are characterized by fluctuations in various economic indicators such as gross domestic product, GDP, employment, and etc. The typical economic cycle consists of four main phases: expansion, peak, contraction, and trough. In the early stages of an economic expansion, our stars are none other than equities. As the economy begins to spread its wings, companies experience a boost in earnings, sending stock prices soaring. It's a performance that captivates investors and sets the tone for a period of growth. As we ascend into the peak phase of the economic cycle, government bonds often play a significant role as they tend to outperform during this phase of the economic cycle. In this phase, central banks may adopt a more hawkish monetary policy stance to control inflation and prevent the economy from overheating. This often involves raising interest rates and causes the yields on existing government bonds to become more attractive relative to other assets. In the midst of economic contractions or recessions, a new theme takes center stage: safety. As the uncertainty looms large, investors shift their holding onto cash and cash equivalents. In times of economic downturn, liquidity and flexibility become invaluable assets. As economies reach their troughs and uncertainties cast shadows, investors turn to defensive strategies to weather the economic low. Defensive stocks, the unsung heroes of economic downturns, are tied to those companies providing essential goods and services that emerge as beacons of resilience. In the face of uncertainty, they stand strong, offering investors a sense of stability amidst the turbulence. In times of economic hardship, gold shines as a hedge against inflation. Investors, seeking a safe harbor, turn to these precious metals, adding a layer of security to their portfolios. In conclusion, understanding the dynamics of different economic cycles is crucial for making sound investment decisions. Investors often employ asset allocation strategies, diversifying their portfolios across various asset classes to manage risk and optimize returns throughout the economic cycle.